what happens when an investor chooses equity over cash flow, or the other way around? We're digging into the age-old debate of what matters more for your portfolio. From unexpected job loss to saving for the future, let's uncover which strategy can truly make you financially free. First, let's go over equity, meaning built-in equity or buying properties under market value. Of course, if you buy a property under market value in Orange County or New York, it probably still isn't going to cash flow. You'll either have to flip it or hold it at a loss with the hope that it appreciates in the future. However, if you are investing in Des Moines, Iowa here, it is likely you could purchase a property under market value and still have cash flow. As with most things in real estate, your primary focus depends on your situation and goals. But in this instance, for most people, most of the time, focusing on one goal is better. So equity versus cash flow, which is better? Now, in a perfect world, you should aim for an investment with both significant equity up front and good cash flow. A property in a decent area will be relatively easy to manage and has a good likelihood of appreciation. Choices have to be made, and you will need to consider whether one or the other is more significant. Generally speaking, the more important thing should be to go for equity, but there is one noteworthy exception. This exception probably only applies to about 0.1% of investors, but it's still worth mentioning. To start off, let's go over when cash flow matters more. For institutional investors, cash flow is the number one metric. They are constantly talking about gross yield, which is your annual rent divided by the price of the properties, and what their buy box is or what types of properties they like to purchase. These firms need to hit a certain return for their investors. For example, a fund might estimate an 8% return for its investors, or an insurance company may estimate it needs a 9% yield to cover its expected losses. For these type of Wall Street firms, built-in equity is nice, but cash flow is the name of the game. So let's cover when equity matters more. Buying with built-in equity allows you to do the BRRRR strategy, which stands for buy, rehab, rent, refinance, and repeat, even if the otherwise here involved a house with better cash flow. You have to remember, it's built-in equity that protects us from the dangers of leverage and allows us to take advantage of its upsides. The ideal acronym, income, depreciation, equity, appreciation, and leverage, is a great explanation for why real estate is such a good investment. If you buy a property for $100,000 but get an 80% loan, you only put down $20,000. Now, if the property goes up in value by, say, 5%, your return is actually 25%. $5,000 divided by $20,000, this is a huge return. But leverage is a two-edged sword. Real estate can go down, which would lead to a loss. But if you get a good deal, that insulates you from the risk of leverage. This doesn't mean that cash flow doesn't matter. You still need to buy properties that have cash flow and net income. There are a few occasions when the trends in an area are so strong, it makes sense to hold a property even if it bleeds each month. But these instances are few and far between and should only be done with a small percentage of your portfolio. However, entrepreneurial investors can pound the pavement and find the gems that slip between the lines. This allows investors to take advantage of the inefficient real estate market by finding motivated sellers, value-add opportunities, and mislisted properties. This is the advantage that entrepreneurial investors have, and the number one reason real estate is the best way for someone of modest means to become independently wealthy. And it's equity that makes you wealthy. Cash flow is just the cherry on top. So let's cover a scenario with two cousins. In this scenario, we have two cousins who are going to buy a duplex. The valuation of each duplex is $250,000. Each is exactly the same, consisting of 2-bedroom, 1-bath units. Each cousin will live in one unit and rent out the other unit to a prospective tenant. Each cousin is employed in a salaried job and makes around $75,000 per year in income, and each has $50,000 in savings. Let's also assume that each of the cousins was able to negotiate zero out-of-pocket closing costs. So let's talk about Cousin A. Cousin A is a highly motivated individual and wants to pay off the property as soon as possible. Cousin A only knows one way to use financing: put down as much cash as possible and finance as little as possible. Cousin A is going to put down 20% because that's what his parents did when they bought their home, and he's going to get a 15-year fixed mortgage, which will allow him to pay off the property in just 15 years. Then, any cash flow that is achieved by renting out the second unit should be put towards the monthly mortgage payment, and Cousin A might be able to pay it off faster than 15 years. Cousin A wants to build as much equity as possible and as fast as possible, while at the same time paying down the mortgage as fast as possible too. The duplex is kept up and it appreciates at 3% per year. Now let's go over Cousin B. Cousin B is also a highly motivated individual, but she knows less about finance. She decides to do the opposite of what Cousin A did and take as long as possible to pay off the mortgage, which means getting a 30-year amortization on her mortgage. She's going to put as little down on the property as possible, using 3.5% with an FHA loan in this case. She's going to save the difference in monthly mortgage payments, around $302, and put that into savings. Just as in Cousin A's duplex, Cousin B's duplex is kept up and also appreciates at 3% per year. So here are the initial numbers. Here's what each cousin's calculation looks like when they are purchasing the identical duplexes. So both cousins buy a duplex worth $250,000, but Cousin A puts down $50,000 while Cousin B puts down $8,750. Cousin A has a loan amount of $200,000 while Cousin B owes $241,250. Because Cousin A put down a higher down payment, he is rewarded with a slightly lower interest rate of 3.75%, while Cousin B has a 4% loan. Due to Cousin A's 15-year mortgage, his monthly payment is $1,787, while Cousin B has an easier to manage $1,485 monthly payment. This is a difference of $302. To start off their purchase, their equity matches their prospective down payments. Because Cousin A wants to pay off his mortgage much quicker, he spends his entire savings. Cousin B still has $41,250 in her savings. The second units each bring in $1,500 in income. And as you can see, Cousin A has a negative cash flow of $287 per month, while Cousin B makes $15 per month. We could predict both properties will appreciate 3% per year. For the next 5 years, everything goes as planned for both Cousin A and Cousin B. The renters seem to be long-term and the rent has been consistent, and there have been no unexpected capital expenditures. The property is worth more 5 years later, so they've both built a little equity in the property. They still have consistent income, so nothing seems to be wrong as far as monthly payments or other expenses are concerned. But before we cover the awesome results after 5 years, I ask that you hit the like and subscribe buttons down below so we can put out better content specifically tailored for you. Now let's go over those numbers. So both cousins' duplexes have appreciated in value and are worth $289,818. Cousin A has a loan amount of $145,355, while Cousin B still owes $218,204. Since they have made their payments on time, Cousin A now has $144,463 in equity, while Cousin B only has $71,614 in equity. Because Cousin A wants to pay off his property much quicker, he still doesn't have any savings. Cousin B now has $59,370 in her savings. In both equity and savings, Cousin A has $144,463, while Cousin B is right behind with $130,984. We could still predict both properties will continue to appreciate at 3% per year. This is where it brings us to the upset. Something happens at year 7. Cousin A loses his job, and since he put down such a large down payment on the property in order to pay the property off faster, he has absolutely no savings. The renter in Cousin A's duplex decides it's time to move out, and he no longer has income in from the rental. Coincidentally, the exact same thing happens to Cousin B. She loses her job, and the renter in her duplex also decides to move out at exactly the same time as the renter with Cousin A. So here are the numbers after 7 years. Both cousins' duplexes have appreciated in value to $308,339. Not bad. Cousin A has a loan amount of $120,468, while Cousin B still owes $207,618. Since they have made their payments on time, Cousin A now has $187,871 in equity, while Cousin B only has $100,721 in equity. Cousin A still has no savings since he's buried all of his funds into paying off the mortgage, while Cousin B now has $66,618 in her savings. In both equity and savings combined, Cousin A has $187,871, while Cousin B is right behind with $167,339. This is where the situation diverges. Since Cousin A has no more income, from assets or not, because of the job loss and rental income loss, he's forced to make a tough choice. Either he can't make his mortgage payment, or he'll have to sell the house. Most likely, he'll have to sell the duplex to get his equity back out. Cousin B, on the other hand, feels okay with where she stands financially after the job loss and the tenant loss. She can make the mortgage payment for many years with her savings alone. She can take her time to find a tenant who fits the mold and is exactly what she's looking for. So there are several variables in this story that may or may not happen, but it illustrates a few points about residential real estate, rental property value, rental income, real estate finance, and just money in general. So let's evaluate cash versus equity. Cash is liquid money and is absolutely essential when you finance real estate. Cash is much easier to use if something goes wrong, like what happened with both cousins, whereas untouched equity is completely useless. You'd have to sell your asset if you ever need that money quickly, and that is always not the choice that someone needs to make if an event occurs. The value of a residential property will go up and down, regardless if you have a mortgage on the property. Value is completely out of your control in residential real estate. It's usually based on someone's opinion, not cash flow. Keep in mind that a key aspect of successful investment property is knowing how to calculate cash flow. It's important to prioritize properties that generate sufficient income to cover their expenses, rather than solely focusing on equity. In other words, the revenue generated by the property should exceed the costs associated with keeping it. The most important thing a buy and hold investor should look for is built-in equity. In the off case, you have to sell sooner than the appreciation can take its toll. The second is cash flow. There are other things too, of course, such as potential appreciation, neighborhood stability and safety, and market trends. But in real estate, first comes equity, everything else follows from there. And if you're an investor, comment down below which you personally care about more, equity or cash flow. If you're looking to grow your portfolio, you should really look at investing in Des Moines here, as we have a very stable market with a lot of potential for both cash flow and equity growth. I'm an agent here and can absolutely help you find properties specific to your strategy. I'll leave my contact info down below. I look forward to hearing from you.